Have you ever stared at a stock chart thinking, should I buy now or wait for the dip? Then you wait and the price goes up. You tell yourself, I'll buy the next dip. The next dip comes, and now you're terrified it might dip even lower. Well, that's basically the eternal struggle of every investor. Should you invest smaller amounts but regularly, dollar cost averaging, or wait for the perfect opportunity to buy the dip? Hey everyone, welcome back to the Wealth Guide. If you're new here, I simplify complex financial ideas so even if you've never studied economics, you can still build wealth confidently. So today, we're tackling a big question. Is it better to invest regularly through dollar cost averaging, or to wait and buy during dips? We'll go over what both strategies actually mean, in plain English, the pros and cons of each, and real-world examples, including what happens if you pick the wrong moment to buy the dip. So grab your coffee, and let's make investing make sense. Investing can feel like trying to predict the weather. You might think you're buying at the right time, only for the market to surprise you 5 minutes later. Even professional investors get it wrong. That's why so many people turn to simple, time-tested strategies, like dollar cost averaging, also known as DCA. And then there's the more daring cousin, buying the dip, waiting for prices to drop so you can swoop in like a bargain hunter. But here's the million-dollar question. Which one actually makes you more money in the long run? Let's unpack both strategies step by step, look at real-world examples, and even explore a fascinating experiment that proved something shocking, that even pro-level buy-the-dip timing couldn't beat regular investing. Let's start with the basics. What is dollar cost averaging, DCA? Imagine this. You decide to invest $100 every month, rain or shine, whether the market is up or down. You're not trying to predict anything. You're just investing like clockwork. That's dollar cost averaging. You buy a fixed dollar amount of an investment at regular intervals. For example, every 2 weeks, every month, or every quarter, no matter the price. When prices are high, your $100 buys fewer shares. When prices are low, your $100 buys more shares. Over time, this strategy smooths out your average purchase price, which means you end up paying less per share overall. It's like buying coffee beans every month. Sometimes it's on sale, sometimes it's expensive. But by buying consistently, your average cost balances out nicely over time. How it works in real life. Let's take Jordan, for example. Jordan earns $1,000 every 2 weeks and decides to invest 10% of it. That's $100 each paycheck into 2 funds, a large-cap mutual fund and an S&P 500 index fund. So every 2 weeks, $50 goes into each fund, no matter what the market's doing. Over 10 pay periods, Jordan invests $500 total. Sometimes the price per share is $9, sometimes $11, sometimes $10. When you do the math, Jordan ends up with 47.71 shares total, at an average cost of $10.48 per share. Now compare that to someone who waited and dumped the whole $500 at once when the price happened to be $11. They'd only get 45.45 shares. Fewer shares, higher cost. So even without perfect timing, Jordan ends up better off just by being consistent. The real beauty of DCA is that it removes decision fatigue and fear. Those two things that make most people mess up in investing. You don't have to worry if the market will crash tomorrow, or if now is the perfect time to buy. You just keep investing, rain or shine, and let compounding quietly work in your favor. Over 10, 20, or 30 years, that consistency pays off big time, because in the long run, markets tend to go up, even though there are dips and crashes along the way. Why people love DCA? There are a few reasons this method has a fan club. It takes the emotion out of investing. No panic, no FOMO, no what if it crashes tomorrow drama. You just invest on autopilot. It helps you avoid market timing mistakes. Nobody, and I mean nobody, knows the perfect time to buy. DCA removes that guesswork. It builds wealth slowly and steadily. It's not flashy, but it works. Kind of like going to the gym, boring sometimes, but powerful over time. It's perfect for beginners. You don't need fancy charts, indicators, or insider knowledge, just a set amount and consistency. When DCA might not work well. Now, DCA isn't a magic trick. If the market continuously drops for a long period, you'll keep buying as prices fall, which might not feel great. And if prices are only rising, you might wish you had invested a lump sum earlier to catch that growth. But overall, DCA works because most markets, especially long-term ones like the S&P 500, trend upward over time. You're betting on that long-term rise, not short-term chaos. What does it mean to buy the dip? Now, let's talk about the flashy strategy, the one everyone on social media loves to shout about. Buy the dip. Buying the dip simply means waiting for a stock or market to drop in price, and then buying it while it's on sale. It sounds smart, right? Why pay $100 for something you could get for $80? And yes, it can work, but here's the catch. You have to know when something is a dip, and not the beginning of a massive fall. Let's say a stock falls from $100 to $80. You might think, perfect, it's 20% off, let's buy. Then it drops to $60, then $40, and suddenly you realize you didn't buy the dip, you caught a falling knife. I'll explain that in a moment. The other problem is that, what if the market never dips enough for your liking? You might end up sitting on cash for years, missing out on gains that consistent investors are quietly compounding on. That's why buying the dip works best for experienced investors, people who've studied the markets, understand volatility, and can stay calm during chaos. It's not bad, it's just harder to execute consistently. It's like surfing. You need perfect timing, balance, and experience. Whereas DCA is like walking. Slow, predictable, and safe, but it still gets you to your destination. When does buying the dip work? Buying the dip can make sense in a healthy bull market, when prices generally go up over time, but have occasional short-term drops. For example, if Apple stock usually trends upward, but suddenly dips 10% due to temporary bad news, that could be a dip worth buying. The key word here is temporary. A short-term drop followed by recovery? Great. A permanent slide into oblivion? Not so great. The danger? Catching a falling knife. There's a saying in investing, don't catch a falling knife. Because if a stock keeps falling and you try to grab it thinking it's a dip, well, you're going to get cut. Take Meta, Facebook, in 2022. It dropped nearly $100 in one day and kept dropping for months. Those who bought the dip early kept buying and losing more as it fell through every support level. So the tricky part is, you never really know when the bottom is. A dip could easily turn into a disaster. How to manage risk when buying the dip. If you're going to buy the dip, you need a plan, not emotional decisions. That includes things like stop-loss orders, to automatically sell if the price keeps dropping past a certain point. Hedging, using options or inverse ETFs to protect your downside. We discuss this in detail in a future video. Patience. Sometimes sitting on your hands is the best move. Remember, arriving late to a rally is always better than arriving early to a crash. The big showdown, DCA versus buying the dip. So which strategy actually works better over time? Let's look at what the data says. A fascinating experiment by Nick Majuli, author of Just Keep Buying, tested this exact question. Imagine this. You're all-knowing. You can see the future. Every time the market hits the lowest point, you invest perfectly. You literally buy the dip at the exact bottom every single time. Surely that beats DCA, right? Well, not really. According to Nick's data, even with perfect market timing, the buy the dip strategy underperformed DCA in over 70% of historical periods. But wait, how is that possible? It comes down to three simple reasons. Dips don't happen that often. Major market crashes are rare, and if you're waiting for them, your money is just sitting there doing nothing. Missed compounding. While your cash is waiting on the sidelines, DCA investors are already compounding their returns month after month. Every dollar they invest starts working immediately. Timing risk. Even if you're off by just a couple of months, your perfect buy-the-dip results fall apart. And in real life, nobody knows the bottom anyway. Take the example of the S&P 500 from 1995 to 2018. From 1995 to 2018, the market saw plenty of highs and lows, including the 2008 crash. DCA investors, who kept investing $100 a month, grew their portfolios steadily. Meanwhile, buy-the-dip investors kept waiting for the next perfect opportunity, sitting on cash for long stretches. Even though they got to invest at some incredible lows like 2009, the DCA investors still came out ahead most of the time, thanks to consistent compounding. So here's the real lesson. The truth is, no one can time the market perfectly. Not even professional investors, and definitely not us mere mortals scrolling through stock apps on our phones. Dollar cost averaging isn't exciting. It's steady, patient, and kind of boring. But it works because it lets time and compounding do the heavy lifting. On the other hand, buy the dip sounds exciting, but it's basically trying to predict the future. And unless you have a crystal ball, it's a tough game to win. So which should you choose? If you're just starting out, or if you don't have time to monitor the market constantly, dollar cost averaging is your best friend. It's automatic, low stress, and surprisingly powerful. It helps you stay invested, stay consistent, and grow your wealth over time, without second-guessing every market move. If you're a more advanced trader and you enjoy analyzing stocks and managing risk, buying the dip can work, but only with discipline and solid research. At the end of the day, both strategies have the same goal: to grow your wealth by buying smart. But DCA is like planting seeds every month and letting them grow. Buy the dip is like waiting for a thunderstorm to water your plants. It might come, or it might not. So if you've been waiting for the perfect moment to invest, stop waiting. Start small, start consistent. Because even pros couldn't beat dollar cost averaging, and you don't need perfect timing to build real wealth. If this video helped you understand the difference between DCA and buying the dip, hit the like button. It really helps the channel. And if you want more beginner-friendly videos breaking down investing concepts in plain English, make sure to subscribe and turn on notifications. I'll see you in the next one, where we'll simplify another finance concept that sounds complicated, but really isn't.